Today's market moves weren't just about rising prices. They reflected a meaningful shift in how investors are thinking about interest rates, growth, and where risk actually sits beneath the surface. Equities moved higher across the board. The S&P 500 gained around 1.4%, the Nasdaq outperformed with just over 2%, and the Dow followed closely behind. At the same time, bond yields declined noticeably, with the 10-year moving lower. But under the surface, the picture was more complex. Oil dropped sharply, gold surged to new highs, the US dollar weakened, and volatility barely moved. So this wasn't a simple risk-on day, it was a repositioning. What changed today was the market's confidence around the path of policy. Recent signals continue to reinforce the idea that the Federal Reserve may be getting closer to easing as inflation shows signs of moderating. And that shift matters because lower yields change how everything gets priced. When yields fall, future earnings become more valuable in today's terms. That's why growth stocks, especially large-cap tech, led the move higher. At the same time, a weaker dollar added to the effect, easing global financial conditions and supporting risk assets more broadly. But then there's oil. The sharp decline in crude isn't just a commodity story. It's the market quietly pricing in weaker global demand, or at least questioning how strong that demand really is. And that creates a tension, because equities are moving as if conditions are improving, while oil is signaling something closer to caution. You can see that tension in how capital moved. Money flowed aggressively into technology, industrials, and materials, areas that benefit from lower rates and policy support. At the same time, capital moved out of energy, where falling oil prices are starting to pressure earnings expectations. Utilities and other defensive sectors also lagged, suggesting there wasn't a strong demand for safety in the traditional sense. But interestingly, gold rallied sharply. That's not typical in a clean risk-on environment. Gold's strength suggests investors are still hedging, still thinking about policy uncertainty, inflation risks, and the possibility that the current narrative may not fully hold. So what you're seeing is a split mindset. On one side, investors are leaning into lower rates and growth assets. On the other, they're quietly protecting against what could go wrong. And this is where some fragility starts to build. Equities are rising, but that move is heavily dependent on falling yields. If that rate narrative changes, even slightly, the support underneath this rally could weaken quickly. There's also a growing divergence in asset signals. Strong equities alongside falling oil suggest that markets may not fully agree on the strength of the global economy. And with leadership concentrated in a narrow group of large-cap tech names, positioning is becoming more crowded. One question investors are actively debating right now is whether this rally reflects a sustainable shift in the macro environment or simply a temporary reaction to falling yields. I'd be interested to hear how you see this developing. Is the market correctly pricing the next phase or underestimating the risks beneath the surface? Stepping back, the broader signal from today's market is this. Investors are beginning to shift from a higher-for-longer mindset towards a policy easing scenario. That shift is driving multiple expansion in equities, weakening the dollar and pushing capital into duration-sensitive assets. But at the same time, the weakness in oil and the strength in gold suggest that confidence in growth is not fully established. So this isn't confirmation of strength, it's an early-stage repricing of expectations. Looking ahead, the next phase of this move will likely be tested by a few key factors. Inflation data will be critical in validating whether yields can continue to move lower. Labor market data will shape how quickly policy easing can realistically happen. And within equities, continued strength in tech will depend on whether earnings, especially around AI investment, can justify the current concentration of capital. At the same time, the oil market may become increasingly important. If the decline reflects real demand weakness, that could start to challenge the broader growth narrative. What this suggests for investors is that the current market strength is being driven more by expectations around rates than by clear evidence of economic resilience, and that makes this environment more sensitive than it appears. If you find this kind of calm, analytical breakdown useful, consider subscribing. I share regular briefings focused on the deeper forces shaping market behavior. And as always, thank you for spending a few minutes here today.